Hey, good morning, everybody. It's Hammer. Today is Wednesday, February 12th, 2025. I, of course, am here with the Daily Mortgage Rate Update, the only place on the web where you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, coming to you on YouTube and on Facebook. If you're here this morning, say good morning. If you're watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Either way, live or on the replay, don't forget to smash that like button, tag an hello friend, share this post in a group. If you're on YouTube, go ahead and click that subscribe button. Give us a thumbs up as well. If you'd like a reminder that I am going live, we send out a text message. It's free. You can unsubscribe at any time. It's hmmr.io/reminder. You'll see that link down here, hmmr.io/reminder. Also, this cool QR code. By the way, I learned something new the other day. If you are on, I know this works with an iPhone. I don't have an Android, so I didn't test it. But if you're on your phone and you do a screenshot and you save this, and then you look at that QR code in your photos and zoom in on it a little bit, it should bring up that link and you can actually click that too. That's pretty cool. I did not know that. So, but otherwise, hmmr.io, we send out a text message real quick just to let you know that I'm live. If you want a reminder and a quick way to grab the link and see what's going on. So let's go ahead and say hi to the live folks. We got a lot to talk about today. The CPI data came in this morning. It did come in hotter than expected. We'll break it down a little bit. I don't want to go too deep on it. I also feel like I've kind of let you down. Everything played out the way that I thought it may. I think I should have just gone with my gut on where this one was going. I tried to leave the door open because we'd had some positive movement. But anyway, we're going to go into that. But if you're here this morning, say good morning. Mandy Kangas, great to see you. Mike Brown said it's snowing out there in Kansas City. I'm actually driving to Atlanta this afternoon, and we'll stay there because it's about 4 hours away, and then grab a flight tomorrow to Jackson Hole. We're going to Tagudi to go snowmobiling. So I'm excited about snow there. Who else we got here this morning? We've got Megan Lindberg. Good morning. Mallory Fotiades, as always. Great to see you, my friend. Amy Blauser. Good morning, Glenn Boussard. Good to see you, sir. Dan Crowley. Thank you for being here. Randy Tico, giddy up, my friend. Mike Morano, good morning. Michael Love, good to see you. If you're here this morning, I missed you. Say good morning. Angela Walters, great to have you here. So, all right, my friends. I'm just gonna dive into the charts. I've had a busy morning, so I didn't get to go deep. So we'll go into it together. So right now, mortgage bonds down about 31 basis points. What does that actually mean? Well, if you look here at say Mortgage News Daily, and yesterday we ended at 7.05. We'd seen things creep a little, right? We were at 7.01, then we were at 7.05. We spent a lot of time at the end of January and into February right at the same level. With the data coming in the way that it is this morning, coming in hot, being down 31 basis points, that means you're going to see your rates jump. This is probably going to go up an eighth. So we're probably all the way up to like, say, 7.15, right? So we're probably back up to where we were middle of January rather here. I don't think you'll see a full 7.25. You're going to be more about where we were here, and it'll go up to at 7.15. But bottom line, rate sheets this morning are getting beat up as we're down 31 basis points. The 10-year Treasury yield has jumped all the way back up, 4.63. Let's zoom in on this for a minute. I may have to refresh. Nope. Oh, cool. All right, cool. So let's take a look here. I kind of want to show you a couple of things. If you look at this red line, remember the 10-year Treasury yield, we want this to go down because when the yields drop, that's better for pricing. When yields go up, that's worse for pricing. When we look over here at mortgage-backed securities, we want these to trend higher. When they move higher, that's good for our rate sheet. When they move lower, that's bad for rate sheet. So looking here at the 10-year Treasury yield, you can see that we spent a couple of days below the 50-day moving average. We tested the moving average here on Friday. We ended right at that 50-day moving average. On Monday, we were once again right at that 50-day moving average. Yesterday, I said, hey, this is not a great sign. Really not excited to see that we broke above that 50-day moving average, 4.54. The problem was the technicals were going to take a backseat to today's CPI inflation data. Let's go ahead and hit that inflation data real quick so we can kind of address that elephant in the room. Let me see if we can just pull up. I'm sure it'll have a chart with the number. Now, this is that whole running commentary thing. Hold on. I just want to be able to, they should pull, let's try this one. This will probably have it. There you go. So the month over month headline number for the CPI inflation report came in at 0.5% inflation versus estimates of 0.3. And we've really been running at about 0.3 month to month. The core, which takes out food and energy, and that's actually a big deal because, like, for example, we've got the, bird flu thing going on, making the price of eggs so expensive. And when you take that out, the core number is really what we're looking at. And it came in at 0.4, which is above the 0.3. That's not a huge difference. You're talking 0.1%, right? I mean, you can do the math on that one. Even I can do the math on that one. It's not really that much worse, but it was much worse than what the markets were expecting, which is why the 10-year treasury yield, as well as other yields, short-term, mid-term yields, have all jumped up as well on this data. Now, year over year, the headline number, as they call it, 3.0 versus 2.9. And then the core was 3.3 versus 3.1. And this is really kind of the bigger one that's hitting its 0.2% higher. And that's a big jump higher for inflation data. Now, what this has done is it's really kind of rained on the parade of expectations about Fed rate cuts. So let me move this window so it fits here, and we'll go over this. Yasmin, good morning. Oh, Morano, didn't Powell talk yesterday? Powell actually did. He seemed like he was okay with the inflation, which is partly why, the what we're seeing here is good morning, Tom Dedmore, Harry Dennis. What's up, Austin? Austin doesn't usually join us. Mike Tebow, good to see you, sir. Tom Dedmore, good to have you. So expectations of a Fed rate cut at the March meeting, they were already 0% expectation, right? So that hasn't changed. Where we start to see a change is when we look at June. The expectation that rates will remain at the 4.25 to 4.5 range, now over 60% for that June meeting. When we compare that to what it was yesterday, it was 50%, and a week ago, it was 34%. This is a huge difference. All right. So markets were pricing in a week ago a 65% expectation, a 65% chance, a probability that we were going to see a Fed rate cut by June. And that has now dropped all the way to less than, 35%. So that's a big difference right there. You could see that it went, it was almost 65%. It's inverted now. 65% probability, 35% probability it wouldn't, 65% probability it would. Now we're looking at 65% probability it won't, and 35% probability that it will. By the time we get to September, that's where markets are basically a coin flip, whether we will see a rate cut. The October meeting, markets expect that we will barely, eke into that idea that we'll see that rate cut. And then by December, we're all the way down, and expectations are much higher that we'll see some kind of a rate cut. So, in July, it's still more of an expectation that we're not going to see a cut. September, it starts to move into where we finally go, where markets say, okay, we should see a cut by September. Only a 42% expectation we won't, right? And then by the time you get to December, that drops all the way down to 3-1. So this is a big difference, though. When you look, again, a week ago, markets were at 10%. They almost guaranteed we'd see an expected rate cut by the end of the year. And now that's only at 28%. Now, also, what is one Fed rate cut? It's not going to bring mortgage rates down. I'll tell you that. I mean, one rate cut. So we're really spending a lot of time vacillating on what's going to happen with the Fed and where the things go. But as far as long-term rates and yields, this has to catch more of our attention, because the reality is, there's not a lot that really sets us up to see rates come down this year. It's already February, almost the middle of February. And what do we think is going to change? If we see these tariffs take effect, if we see inflation push higher, again, I figured by now we'd start hearing rate hike talk, and we're not hearing that yet. But if we get jobs data on March, the next one that come in should be March 7th, right? If we get jobs data that comes in showing a strong labor market again, I think you're going to hear more talk about that, especially as we get into that March meeting. Right now, Powell has said that he thinks that it's okay where the Fed rate is, what they call the neutral Fed funds rate, where it's not pushing mortgage rates and other rates higher, where things aren't going. But this is definitely not what we want to see. A 35 basis point drop is ugly. Like I said, you're gonna see rates bump up 1/8 of a point today, a little bit more for lenders that are pricing less aggressively, that are more conservatively. But overall, I think we'll see some recovery on this because the outlook, even though that inflation number did come in a little hot, it really hasn't changed the outlook and the expectations. I think we'll see some different Fed speakers out there talking about where we're at. And this is the CPI, not the PCE. So we're not looking for this to hit 2% yet. Ron Siegel says, let's take a look here. You said Bessent will bring mortgage rates down by reducing the supply of 10-year treasuries, increasing the supply of shorter term notes. Yeah, we talked about that the other day, and I'll kind of, go back on that. So the Fed's policy rate affects short-term interest rate lending. Mortgage rates are a longer term. They're actually like mid to long-term rate, right? So you're not going to see that have quite the same effect on it. And what Ron is talking about is that the government, not the Fed, want to see mortgage rates improve, right? And the way that they would do that is by manipulating markets. What the Fed would do is quantitative easing, where they would buy up mortgage bonds, where they would buy up 10-year treasury yields. 10-year treasuries, driving the yield down. What the government will do is when issuing debt, first thing they're trying to do is issue less debt. And that's why you see all the talk about all this savings. There's a lot of headlines. Again, we have to talk politics, people. Keep your big boys and girl pants on because we're not getting into it. There's a lot of talk about how all this money is saved. One thing to know when you see these billions of dollars thrown around, these are numbers on a piece of paper, but the money doesn't always change hands. We had so much money from the COVID era. We spent $200 billion on this. Well, but most of that money may not have even ever actually made it out to those organizations or buying those things or doing those things. They've been allotted for and approved for, but the money didn't really go anywhere yet, or the money wasn't even used yet. So remember that there's a lot of headlines with this stuff. And it's a very complicated topic, the way it breaks down. But if the government is spending less, because we talk about spending our tax dollars, but our tax dollars account for a very small, a disturbingly small amount of what we actually spend. We borrow to spend. And if we're borrowing less, that puts less supply in the market, which means that the demand can increase, which means the yields can drop. Okay. And as we borrow, the Treasury has the ability to borrow many different ways. We can borrow short term. I could say, hey, listen, I'll give you $5 if you loan me $100 till Tuesday. Remember what Blimpie used to say? Was it Blimpie? Is that his name, right? On Popeye? And he'd say, I'd gladly pay you Tuesday for a hamburger today. So if you're only going till Tuesday and you do short-term borrowing, it's a higher interest rate generally because it costs more to borrow short-term. But the effect is it'll keep that 10-year treasury yield lower because we're not putting so much supply in. What we'd generally want to do is borrow longer term, and then you're borrowing at a lower interest rate. The other thing too is what direction does Bessent think rates will go? You don't want to borrow money today at 8% if you think that in 4 months it's going to go down to 4%, right? So that's kind of how that works. Amber, can I explain how the basis points in bonds help you say rates will be 1/8 different today? How would I know the change in bond pricing? Yes, I will go ahead. Let's hit that one real quick and I'll show you. So generally there's a couple of different things. It's not always, and it's not usually dollar for dollar, if you will. So if you see a 35 basis point adjustment, let's say that it was dollar for dollar. Rate sheets today, if you were pricing 7% and getting a point in rebate, today you would be pricing at 7% and you'd be getting 35 basis points less. It would cost you I'm sorry, instead of getting a point in rebate, you would get 65 basis points in rebate. Let's say it cost you a point to get 7% yesterday. Today, it's going to cost you a point and 1.35. That's like the way that you would, if it was a perfect world and it equated over there. Now, generally, you look at your rate sheets and you say, well, how much does rebate have to move before I see pricing actually jump that eighth of a point in rate? So when you look at your rate sheet, 7% may be paying back a half, and 7 and an eighth costs you a quarter. And you could see where you're going to be, or I'm sorry, vice versa on that, right? So 7 and an eighth pays you a half, 7 you're paying a quarter. So you can see that variation there. Generally, if we see a movement like this, I'm going to see most rate sheets, they're going to move enough that you're going to price about an eighth of a point different in rate. There's no hard and fast number, but 35 basis points is about an eighth. If we were at 70 basis points, it would be about a quarter. You can use that as a rough estimate. It's going to vary lender by lender. There's a lot of variables to it, and I'm oversimplifying a few things, but generally that's what you're going to see, right? So you'll see that overall. Lenders are also going to price according to their pipeline, what they're hedging, fallout. There's all kinds of things that go into it. Some lenders will price more aggressively on these cuts and are slower to give it back. Some are trying to get business. So hopefully that helps. Yeah. I know. Ron said clear as mud. Good morning, Alan Christian. Good to see you, sir. Hope you're doing well, my friend. So let's kind of spin this a little bit and go, where does it go from here, right? So let's take a look at the technicals. If we look at these candlesticks and we look at the technicals, when we want these candlesticks, these are the mortgage-backed security prices. We want these to go higher. When they go down, we're losing ground. So you can argue and say, okay, well, where is that line in the sand? How far will this go? What are the technicals from here? Well, we were all the way up here. We were testing this green line, the 100-day moving average. We were testing this purple line, the 200-day moving average. Now, if these levels are above where we're at in bonds, where the candlestick is, they are resistance because they're going to cause us to resist moving higher and improving. Remember, moving higher would be good. If it's the opposite direction, it provides support. If you were falling and there was a rope there that you caught, provides you support. So yesterday, we broke through this 50-day moving average. We ended the day 100.62. The 52-day moving average is 100.64. Here's a tip, by the way. We don't actually sell bonds in basis points. They actually sell in 30 seconds and or some, we call them ticks, right? So like that 0.2, that 2 basis points is actually the same thing. It's like a rounding thing. So we really ended right here at that 50-day moving average. Now we could have argued that would give technical support. If there were no other variables, maybe we get a bounce higher from that way. Maybe we improve from that. But when you have what we have to happen here, where the actual inflation data comes in, and this has more of an effect, what basically the reason the inflation is such a big deal, we talked about how it affects expectations of Fed actions, but the other big thing is is how much is my money going to buy in the future? Inflation erodes buying power. If I loan you money and I'm getting $1 a month in interest, and that dollar buys me one Kirkland sparkling water today, well, what about in a year? What if I need $2 to buy this, or $1.50? What in 5 years I need $3 to buy this? But I'm still only making $1. So that's why when you have inflation, it erodes buying power. Anybody that's buying things today and you say, my money just doesn't go as far. I'm still making the same amount I was making before, but when I spend it, it costs me so much more to buy anything, so I can buy less. And that's why inflation is bad for bonds. Bonds are a fixed income asset. You're getting the same amount of money back over time. And in fact, again, we're oversimplifying it. In mortgage-backed securities, it'll actually chip down a little because of early payoff. And that could be because of people refinancing, as well as for if they are going into default. So this, when we have inflation going up and the inflation is ticking up, well, I don't want to invest in something where I'm fixing the amount of money that I'm going to get on it if that money is going to be worth less later. So if I anticipate that if my dollar is not going to buy as much a year, 2 years, 5 years from now, I would say to you, I'll tell you what, I was going to lend you $100 and you were going to pay me back $1 a month for 10 years, because let's use the 10-year treasury yield, right? And you're going to give me, let's say the yield here, the yield is on the 10-year is 4.64. So you're going to give me $5 a month for that. Now, like the 6.0 coupon, let's pretend that was $6 a month. There's no prepayments. There's no other factors, right? So I could invest in the treasury and get $4.65 back, or I can get $6 here because there's more risk here. That's why you get a little bit more for your money. Well, let's pretend I'm going to give you $100 and I'm going to make $6 back for the next 10 years is the average. So even when we look at a 30-year coupon, we figure it's only going to hold for about 10 years. So, well, if my $6 is not going to buy as much in a few years as it does today, I'm not willing to give you $100. I'll tell you what, I'll give you $98. And when you pay me back, you have to pay me back $100 plus the interest. So that's what drives up the yield, because they're willing to pay you back more. You're buying something at a premium. That's why it's either a premium or at a discount. Right now, a 6.0, we're spending $100.25 to get $100 worth of bonds. So you're overpaying for it because you're getting more interest over time. If we were to turn around and say, well, the 5.5, I'm getting less interest over time. So if I'm going to buy that, I'm not going to buy it for the same amount because I'm making less over time. So I'll give you less money. I want it discounted. I'll give you $98.23. You give me $100 worth of bond. And at the end of the term, I'm going to trade it back in and I get my full $100. I only paid $98.23. So I'm going to factor that profit in over the time. And that's why the yield improves, right? And if I look at, say, the 5.0, that one's discounted even more. Why? Because I'm getting paid less interest over time. So this difference, this other, $4.04 is, if you divide it out over time, it brings up the amount that I would be gaining over that same time, makes it closer to that 6.0. And that's how all this stuff works. Again, oversimplifying it so nobody needs to rip me for, but that's basically the bottom line. It's how it works. So when we see this inflation report, it makes our investments worth less because we're thinking we're going to be able to spend that money and get less for it later on. And when there's concern that inflation is ticking up, then that's a problem. And that's where we're at. Ron said, today's one of those days. Remember, the market always overreacts. It may take a day or two. We'll cover some of the overreaction. Yes, and that's what I talked about in the lock advice, my written lock advice yesterday, as well as here. I said, listen, anything closing near term, consider locking it because we just couldn't take the chance. There were some signals that we may see better inflation. Well, obviously that was wrong. That wasn't the case. The shelter component, you could do the math. But remember, I said the January 1 is a big one because you get changes in the seasonal adjustments. And we don't know exactly how they changed that, but they do change the seasonal adjustment, changes in seasonal adjustment, CPI. That happens in January. Okay. Updated seasonal factors to be introduced February 12th, 2025. So that did happen today. So what happens is we don't just take raw data and say, well, here's the CPI number. Here's how things have changed. They go, well, we have seasonal adjustments based on what season is it, when in the year, and well, there's different things. Well, we would expect that way we can compare things all across. And you know what? It's kind of like APRs, and they work just as well. The APR is so you can compare a car loan to a home loan, to a title loan, to a secured and an unsecured loan. The APR is supposed to make it so you have the same thing that you can compare apples and oranges together as bananas. Doesn't really work that great. It gives you an indicator, but it doesn't work that great. And this is the same kind of thing. So it's supposed to level it off so that you can get fair comparisons instead of just looking at the actual data. So we could say, well, if January was like December and the weather and the different things, well, it would have been this. We don't know what the changes were in the seasonal factors, but we do know that it could make a change. Could be part of the reason why we're seeing such a different number here. It may not be that big of a difference. We may not really have seen that much inflation. It might be the seasonal factors that are adjusting it as well. And then some of that comes into play. Ron, I used to get a dozen eggs for $2.99. Now I only get 3 eggs for $2.99. Yeah, what's happening? All the folks who took 2%, there's no way inflation was not going to stay low for 30 years. That's true. But at the time, you had to do something with your money. So where do you invest the money and how do you invest it to maximize what you're getting? And then, that was why when they were putting it at 2, that's because everything else was paying 0. Right? Remember, if I put money into a savings account and my savings account was paying me 0.01% and I'm making no interest, well, 2% is actually pretty damn good. Now I can put my money into a savings account at mid 3s, right? And that means that 4% is good or 4.5% is good. So there's always money moving, Mike, and that's what you have to remember is there's always money. So yes, if you wouldn't take money from a high yielding account and move it to a lower yielding account, but if your aunt died and left you, $300,000 and you have to invest it and rates were at 2% versus 0%, well, you're going to put it in 2%. And then that's why now, if you sell that 2%, you're taking a loss on it. So people sit on it. And this is where we get into mark to market and all these other things that get really complicated. So, but at the end of the day, yes, that is kind of what's there. So hopefully today helped y'all. I appreciate you being on and I hope that this gave you some insight. I want to just pick up kind of where Ron said, I do think we'll see some recovery. This is not a huge problem. This is not, it's not going to happen tomorrow. But we're not really that far from where we were anyway. If we go ahead and let me pop the screen back up one more time. We'll do the whole screen for a minute. Let me pop this on here. Hold on. I got to getting used to there you go. Okay. So you take a look again, we're down 37 basis points. It's not where we want to be by any means. When we look at this candlestick though, look at where we were back here in January. We were, 99.65. Remember, this was the jobs data, right? And then we recovered from that. When you see these big losses, you're going to get people buying. So we, back here, this is another CPI print, the December 18th, right? So you could see that there was, I'm pretty sure this was CPI, might have been earlier, but same thing's going to happen regardless. When you see these big drops, you're going to get some recovery. We're not going to come all the way back up, especially in the next couple of days, because we've seen a shift in the outlook. And when you see a shift in the outlook, and we could see that here when the Fed futures, when you see that shift in the outlook, that has more of an effect on things. Because you're not going to just get quite that same recovery. Using the 10-year treasury yield, I think, is a great one to kind of reference for here on where we're at. So 4.65, again, over the last 6 months, you could see that this is where we're at now. We were higher in January, but we were tremendously lower last year. And the reason, by the way, with rates, I've talked about this, but we need to bring it up again. Rates are actually better than we've seen in past years because the spreads have reduced. The difference between the 10-year treasury yield and mortgage-backed securities has gotten smaller again. When that spread got very far, rates had to get worse in order to catch up to that 10-year treasury. If I could invest my money in the 10-year where it's guaranteed, I need to get more money from mortgage bonds. And again, oversimplifying, but that's kind of what was happening, right? Now, those margins have started to come back down again. The spreads are still higher than where they've been historically, but they're not nearly as bad as they were. I don't have the charts up because I wasn't prepared to really go into that, but that's what's helping us. It's why we're not seeing, instead of rates being in the low 7s, this is equivalent to where we would have seen them in the higher 7s, like 7 3/4 would be a half a point higher than where we're at today, easy. So this is not terrible and brutal. And you're going to see rate sheets do what they've done for the last, say, 30 days. If I bring this over a little bit and you go here and let's use optimal blue. We'll get rid of the other two. Just looking here, it's the same thing that we see here, right? We see the last 3 months rates went down, then they kind of creep back up, then they came down. Now today they're going to creep up. They're not going to go nuts. We're not going to see rates that are going to just keep going up and up. In 15 days, there might not be much of a difference. It's only 30 something basis points. Reprice risk on the day is moderate. We could see it trigger a sell-off, but it's been very stable. We saw an initial move and then markets kind of priced it in and kept there. As long as we see that, there's nothing to panic about. If we were to see another sell-off, if we see what we call avalanche selling, snowball selling, where it continues and gets worse and worse and worse, that would be bad. So, all right, my friends. Well, I certainly, here you go. So Ben said, I have a file closing 3-6. Would it be wise to float a little longer? Well, I mean, start the day floating. Again, that fell like right within that, 2-week period where I would have been like, I might have locked that up ahead of this. But yeah, you want to at least float. And here's what you're looking for next. We want to see what happens with this 10-year treasury yield, right? Are we going to see it break? Right now it's at 4.65. It hit as high as 4.8 back here in January. Does it continue to move higher? Because that's a real possibility. I mean, and how much higher are rates going to go? And then are they going to come back down? You don't have much time. What is that? 3 weeks? So today's the 12th. So you got 19th, 26th, 6th. So you got about 3 weeks. So I wouldn't lock today. Let's see how the day settles. Really, you're looking for confirmation tomorrow. How much do we get any kind of recovery, like what Ron Siegel was saying, or are things going to continue to worsen? Is this a trend where things continue to go up? Normally, when you get a big move, you may get a follow-up move tomorrow, and we'll see where this 10-year treasury yield goes. But I do think we're going to actually see it kind of come back down. I think with 3 weeks, I think you've got time. Remember, I don't have a crystal ball. I could be wrong. But I do think you'll see it at least recover a little bit. Being 38 basis points is not the end of the world. We want to see more of the trend. What is concerning is that how we've broken through certain technical levels, as well as expectation. Again, not that the Fed rate is going to control where your mortgage rates go, but it shows you where markets are putting their head. And markets are pricing in the idea that we're going to see inflation. If we get continued, you've got the tariff stuff going on. Trump can definitely be mercurial. We don't, he could do something and announce something or say something. Markets have gotten kind of used to it from the first term, so they're a little less jittery, but he could do something that spikes things up. But they do want to bring rates down. And, him or Bessent could turn around and say, this is what we're doing. And this is why we want to bring yields down, and markets will react to that. So give yourself a little bit of time. Don't react on anything today, and we'll see how it all pans out. So, Ron said he's got one closing on the 25th and he's floating. No mute button, Ron. You got to listen to me. Blow my nose and sneeze. So, boogie check. That's the problem with having big nostrils. You can see all the way up them suckers like a cave. So, all right, my friends. Well, I think that about wraps it up. Thank you so much for joining me. I'll see y'all tomorrow, and we'll see if we do get any kind of recovery, and we'll take it from there.